name is Scott Phillips. I'm the partner in charge of our national insurance office here at Eide Bailey. And then Andrea Mao is our accounting leads. And we'll be presenting today talking about revenue. It hasn't gone away. We've been talking about it for about a year and or for a couple of years now, and kind of a refresh of a couple presentations that we've done. Hope everybody is well and safe with social distancing and working from home and all those types of things. I think my favorite meme that I've seen so far is the school is coming out with my kids' class teacher assignments for next year, and I hope I'm not one of them. So hopefully, school will be back in session. We'll see. As we get into this a little bit, here's the overviews. I'm going to take the first half or so of this presentation and talk about revenue recognition, which is a pretty broad topic. As I look through the list, there's a lot of different industries, and it applies to lots of industries and entities differently and uniquely. But I'm going to go through kind of some lessons learned through this last year, through the implementation phase. And then Andrew's going to jump in and talk about some of the tax implications of what's going on. Of course, starting out, I want to talk a little bit about just the 5 steps. I'm not going to spend a lot of time on this because people should be, hopefully you're familiar with these 5 steps, but just as a refresher, when the FASB came up with this model, it was supposed to be or expected to be a one size fits all across all entities, as they were coming out with guidance that was industry specific, and as each industry evolves and the guidance was unique and might apply to across industries, it was becoming much more difficult to write guidance that affected that affected all these different industries so uniquely. And so they came up with this principles-based model where you go through these 5-step structures. And we're going to touch on a couple of these steps today. Again, in the National Assurance Office, we've done a lot of consulting with clients and with our audit engaged team members and our the various accountants within our firm. And we've had a lot of questions come up, and some with some common themes. And so we thought we'd just touch on a couple of those things. And so you might take some notes on whether or not these things impact your business. So with that, now that we're kind of in this first wave of implementation, our first polling question, how have you been, as you've been working through 606 this year, and many have implemented and maybe some haven't yet, or still working through that process, have you determined in that there are significant changes as you've implemented? Yes, no, or you're still not sure yet? As people are answering this polling question, I'll kind of continue on, like Amy said. It's interesting as we get into this. Like I said, the devil's in the details, and as people put pencil to paper, they start to flesh out some details that maybe weren't considered when they first looked at this. A lot of individuals have said, well, we don't think there's a significant impact on our business, but as they got into the details, there actually are some differences, some tweaks, some unique twists that did have more of an impact than was originally anticipated. So the first one I'm going to talk about is these subcontract issues. In these first couple of bullet points, we talk about an enforceable right to payment with no alternative use to the goods. What we tend to think about when we think of those terms is construction contractors. Yep, I'm going to go and I'm going to pave a road, or I'm going to build a building, and it has no alternative use to the individual. In other words, it's not a widget they can sell to anybody. And so in those instances, then they would recognize revenue over time. They're building a road, they can recognize it over time. And in other words, that's formerly known as the percentage of completion method. Normally, when you have manufacturers and they're creating widgets, normally they just sell the widgets when they ship them or when they're delivered. But what we're finding is that you might have a manufacturing company, and they normally sell a variety of widgets that they produce. But then they'll have customers that come in and say, hey, I want a customized product. And when they go to customize that, it really doesn't have an alternative use. In those instances, that manufacturer, who normally probably has recognized revenue when they delivered that product, now because they have an enforceable right to payment with that customer who's asked for a customized widget or set of widgets, they would actually recognize that over time or use a percentage of completion on those widgets. So that's a change that a lot of people are coming across, where, again, if you're customizing anything for a particular customer, that potentially you may have some of your goods that you're producing that you would actually recognize on a percentage of completion method or recognize over time, as ASC 606 frames it. There is some question about, well, what is an enforceable right to pay? Normally, there's the contracts. Frequently, we're seeing contracts are written that, yep, you don't owe me payment until I deliver them. But technically, if you ever call me up and say, hey, I don't want them anymore, you have to pay me for anything that I've done up to this point in time. So technically, you are earning that as you're creating or producing or manufacturing those goods. Some places, if it's not explicit in the contract, or maybe it is explicit, but certain jurisdictions have restrictions on that. So, we're not here to give legal advice, but that might be something you look into, is if your contracts are uncertain, or if you think you're in a jurisdiction where you may not be in a situation where you can force payment if you don't complete an order or until delivery, then that enforceable right is a question that people are needing to find answers for. So that's something you'd want to look at your contract and potentially look at the jurisdiction you're in. And another area that's been interesting is certain service industries. So, for example, if you're a dealership and you sell cars, so you're going to recognize the sale of that car as somebody comes and makes payment and takes delivery of it, or drives it off the lot. And you also sell parts, and that's fine. You sell those. And then you have a repair service where if somebody comes in and drops off their vehicle and you do some repairs on it over the course of a week, if again that individual at any point in time says, hey, I want my vehicle back, and you have performed some repair where you're entitled to some payment on that, then technically they should be recording that repair over time. Now, in the case of a dealership, a lot of times those repairs are done in the course of a couple of days or when they actually get started. So maybe maybe it's not material, or there's only a minimal amount that cross year end or a period end when you're doing reporting. But we've come across some entities that do major repairs of machinery, major repairs of uh, call it big equipment. Some of them take tractors, and it'll take them 3 months to tear a tractor apart and prepare and repair it. They'll tear it apart, order certain parts. Maybe they even have to customize a few parts themselves, where they, um, create them in house or whatever. And in those cases, anytime that somebody would want to come and take that piece of equipment back or stop the service, technically you have an enforceable right to payment for anything you do as you do it, as you go along from day to day. And in those instances, then you would recognize revenue over time. And again, a lot of entities were normally recognizing revenue because when they were billing it, which was when they completed the service. But technically, you're in many of those instances, entities were entitled to payment along the way if they so chose, or there was some obligation for that customer to pay them. So those are situations where, again, there's maybe a few more places where people would use a percentage of completion method, or again, as 606 frames it, over time, that weren't doing that before, where they were just trying to do it as they build it. And so those are some things to take a look at your contract, take a look at the service you provide, whether or not there's any sort of customization, or if it's a service that takes place over time. Those are some situations in which you would want to review your contracts and your revenue streams and determine whether or not there are some differences in recognition with the implementation of 606. Another area we've talked about is price concessions, whether they're explicit or implicit. Implicit being customary business practices. You've got you normally give away free goods and services, and people have expected that. Published policies, statements of what you're going to do, or if it's actually written in the contract, those need to be considered into the purchase price. So let me give an example of that. Let's say you go to, kind of a common one, particularly around the holidays or whatever, you go to Kohl's to get whatever you buy there, and you get Kohl's cash. So if you go to Kohl's and you spend $50, they give you a $10 gift certificate, and that $10 can then be used if you come back in the next 2 weeks. You can use it. So let's say you spend $50 and you get a $10 gift certificate. You come back a week later and you buy another $50 worth of stuff, but you only had to pay 40 because you had this $10 kind of Kohl's cash. So the first time you went in to spend, you spent $50. The second time you came in, you bought $50 worth of goods, but you only spent 40. So the net cash you gave Kohl's was $90. The expectation is that you would actually only recognize $45 for each of those purchases. So the first time you came in and you spent $50, you would only recognize $45, and that extra $5 of cash they got would be a deferred revenue, and then it would get smoothed into the next time you came and spent $40, then they'd recognize the remaining five. That sounds easier in concept than practice. Certainly there's some estimates involved in, you know, what are the returns, what are the rebates, especially if there's step up in concessions. If you purchase so many of these, you get this rate, but if you purchase, you get, say we sell things $100 per widget, and if we buy 100 widgets it's $100, but if you buy 200 widgets then it's $90. And so you're estimating. What the new standard says is, let's estimate what we think that's going to be based on redemption rates, historical data, you know, then we'll estimate how often do people hit these benchmarks, or in the case of my Kohl's Cash example, how often, what is the typical redemption rate of that $10 that we gave away? What's the, estimated redemption rate? And if only 25% of people come and redeem it, then, you do some statistical data to determine how much of that then would you actually recognize or defer. So there are some components to that that take a little bit of work. The difficulty in those situations is that commonly these are negotiated outside of the accounting department. And so what we're finding is we're needing to get in and talk to either a sales department or a marketing department on the types of programs they have to incentivize sales to various customers, whether it's a retail shop and they've got coupon programs, buy 2 bags of dog food and come back in a week and get a third free, and need to smooth that over that time period. Or if it's embedded in a contract where we've got a specified contract that says based on purchases, the more purchases you make, the more we'll discount or provide rebates, refunds, or any of those types of things. So again, having to get outside the accounting department, talking to marketing departments, sales departments, how are they tracking those? What types of concessions they're offering? Are they crossing any sort of period end where we're doing reporting? Those are the types of things where they're much more pervasive than people thought. Loyalty programs, those types of things, much more pervasive than people had realized. And particularly, trying to track that information down has become problematic. And again, getting to the marketing department, the sales department, that's where we're finding kind of the most success of getting information and potentially data. A lot of times, while this isn't an outcome of 606 per se, or an expected outcome as far as accounting goes, there's actually some good things happening in terms of organizations really figuring out where they're at with customers and really where they're at with discounts and rebates and redemption, and which programs are working or not working. And so doing those types of things, people are getting some better accountability determining which programs are being productive programs. So that is kind of a byproduct of going through this exercise, which is a good thing. But again, an area where it's much more applicable than people had originally anticipated. And so wanted to touch on that. We talked about this last year as well, or in other presentations, but some accounting changes related to 606 is this concept of a right of return. I put an example in here just because I think the illustration is, picture's worth 1,000 words. But so in this illustration, an entity sells 100 widgets at $100 each, and the cost to produce that widget is $60. Normally they find that they have 5% to get returned. So when they first sell that, they get cash at 10,000 and they've got revenue of 9,500. And we've always had some concept of a sales return allowance, but in this case, you've got this refund liability where we're not going to recognize that revenue. We're going to call it a refund liability instead of just a net, sales allowance that would normally go against the sales. We're going to say, no, we think this sits in another liability. And then on the cost of sales piece, you also are going to get those goods returned to you. So you have this other asset. You have a cost of sales in your inventory that gets relieved, but then you have this other asset. It's not really specific what that is. A lot of times people are making it some subset. What I'm finding is people are making a subset of inventory, either separately, some other asset, or they're calling attention to the disclosures saying, hey, within our inventory is also this right of return of inventory. So people are paying it at different places, but those are some new accounts that people are trying to find where those go. Another point that's been interesting is coming across, whether or not when we're producing some sort of widget or goods, is it shipping point or destination? And does the contract specify what that is? Under 605, there was this concept of what we call synthetic destination, or FOB, destination. Meaning, our contract said shipping point, but really our practice was we were always we will cover that if it gets damaged or if it gets lost or anything like that. We're going, the company's going to cover that. And so while our terms all say shipping point, in practice we really do destination. And so some entities were recording destination on this, what they call synthetic destination, because that was their customary business practice. Under 606, it's much more specific to the contract. What are the legal terms of the contract? What are you obligated to do? And if your contract says shipping point, then you should be recognizing shipping point rather than destination. This caused some conflict, and actually some supplemental ASUs came out to clarify and add some color to this type of situation. And so they came down to, if you look under fulfillment, they talked about the fulfillment of the contract. And this first bullet says customer takes control of the goods before shipment, meaning shipping point. So if your contracts say that you're at shipping point, but your customary practice is that you're taking care of the shipping, and if the goods are damaged or lost or anything like that, you'll replace them, any of those types of things, then if the contract still says at shipping point, then you recognize revenue at shipping point. Then the question is what those customary business practices of providing if there's damaged goods or lost goods that you're going to replace those. What do you do with that? Again, the contract says shipping point, so 606 says you should recognize under shipping point. So the question is this fulfillment activity, meaning the fulfillment of getting the product to that individual, making sure that it's not lost or damaged or whatever else. That you have two options. One is that you just say, well, that's part of the fulfillment of the activity. But in other words, we think that once we've got it on the dock and it's shipped out, then we're done with our performance obligation. We do have a customary business practice, but really our performance obligation was done when it was shipped. And if we have to fix something along the way, we'll fix it. But our performance obligation is done. The other option that you could have is you could say, well, we think producing that widget or taking that distribution center and getting it shipped, we think the performance obligation is done because that's what our contract says. But we think that we have some obligation to make sure that that product makes it to its end destination. In that case, you actually don't do FOB destination. Rather, you would split your revenue into two pieces and say, well, we're going to recognize X amount, probably the majority of that amount, when we ship the product. And we're going to hold some of that revenue back and recognize it when it gets delivered, because we think we have a performance obligation to make sure that that product gets there. And so you're actually allocating your revenue into two pieces: the widget that you sold, that you shipped, and then some obligation to make sure the shipping takes place and that you receive that product. Again, that's an allocation, not an all or nothing at shipping point or destination. Again, if I come back, you have two options. If you fulfill it, if you determine it's just a fulfillment activity, you can recognize it all at shipping point, or you have the option to allocate some portion of that to the shipping activity when it makes it to the destination. Regardless of what you do, you have an option to do either. You have to disclose that. So making sure in your disclosures that you've made it clear what your policy election is in your revenue accounting policies, that either we consider fulfillment activity and we do it at shipping point, or we allocate some portion, and that portion then once we've fulfilled that obligation, that separate performance obligation that we've identified to get the product to the customer, we're going to do that at destination. So again, regardless of what you do, those are policy elections. And then this last bullet point just says, the customer takes control of the goods upon delivery, meaning it's an FOB destination. In those instances, the obligation is just to get it to the customer. So you only have one performance obligation, which is, you recognize upon delivery. So you don't necessarily need a policy election when you're in a FOB destination environment. If your contracts, again, I'm going to say this a few times throughout, the next few minutes, but if your contracts are not specific to ship point or destination, then you should work with, the individual within your organization who develop those contracts, as well as if potentially any legal, to make it clear in those contracts so that you can align. If it's not clear, then it comes back to kind of what your interpretation business practice are, but it's much more difficult in those situations if it's not clear. So another area where there's been a lot of discussion is upfront fees. So some non-refundable upfront payment that's required. This is common in, the software industry. It could be gym memberships or club memberships that require some sort of activation fee or initiation fee. And particularly in the franchisor arena, there's a lot of upfront fees that are required. And generally speaking, the guidance around this is that there's, and again, it's facts and circumstances, so not speaking definitively on all situations, but generally speaking, those upfront fees are not considered to be connected to a specific performance obligation. And because they're not connected to a specific performance obligation, what they should do is we get capitalized and then or deferred and then smoothed over the estimated life of that customer or that client. That's an area that there's a lot of kind of confusion on and a change in practice for many entities. And particularly with the franchisors, what happened was is there's a lot of pushback. And so in this last bullet point, here's kind of an interesting thing that happened. And this slide is already outdated. I put this together on Saturday and or finalized this on Saturday on a Monday, kind of time frame, and now it's already outdated but as of yesterday. But FASB proposed here about a month ago to defer 606 for franchisors because there was a lot of discussion around this particular area. And it was interesting, unprecedented that FASB would delay a standard after it was already effective over a year ago for public entities, and then this last year for 12/31/19, years ending 12/31/19, effective for those entities, this year for 12/31/19. Anyway, with these franchisors, what was happening is they were having some frustration with how to manage this non-refundable, and FASB wanted some time to think about it. So with some of the questions FASB about a month ago proposed, along with kind of COVID-19 happening, they proposed to defer, and it was just an exposure draft for 606 specifically for franchisors, which was interesting because most franchisors had already implemented. But as of yesterday, the FASB just approved to actually defer 606 for all entities that haven't already implemented, or if you haven't already issued your financial statements. So while it's already effective and many entities are already issued, FASB actually yesterday deferred 606. So if you haven't issued your financial statement, then you can actually defer this a year. If you've already gone through the exercise, unless there's significant questions, I don't know that I recommend to just defer at this point. But in any case, there is an option to do that. So just groundbreaking news. So then in kind of getting towards the conclusion of this, but I do have one slide to hit on the CARES Act. A couple of things that we've noticed in the disclosures is just reminding people that when you're putting together disclosures, there should be some expanded discussion. A lot of disclosures pre-606 basically said, we recognize revenue when we've completed, when there's evidence that we've completed our performance or whatever. It was pretty light. Now there's expectation to talk a little bit more in depth, 3 or 4 sentences to a paragraph, and potentially by revenue stream, and particularly if you have some revenue streams that are some revenue streams where you have shipping point to destination, or some revenue streams where it's point in time and overtime, there should be expanded disclosure on those. For non-public entities, if you have, again, in my manufacturing example, if you determine that we do have some goods that are recognized overtime and some at a point in time, then in the disclosures, you're required to split out which revenues were recognized over time and which ones were at a point in time. For contract asset liabilities and receivables, so contract assets, contract liabilities, and receivables, you're actually required to disclose your beginning and ending balances. In this first year of implementation, most of our clients have used the modified retrospective approach. And so the beginning and ending balance would just be for the current year. But going forward in a comparative situation, that means if you have a beginning and an ending balance for comparative statements, you actually should have 3 years. So you can't just rely on it's in the face of financial statements. We're clear that we have deferred revenue, which is a contract liability. We have some unbilled contracts, which is a contract asset, and we have some receivables. You can't just say, well, those are clear in the face. After you get past this year, there should be 3 years of information. And then we talked earlier about fulfillment costs. Your policy disclosure, if your FOB shipping point, but you have a customary business practice of fulfilling that, make sure that any lost or damaged goods, what is your policy for that? You should make sure that the fulfillment is in there. So I'm going to continue on and touch on kind of my last point here, and then I'll hand it off to Andrea, is the CARES Act. There's been a lot of discussion on the CARES Act and these Paycheck Protection Act, where people are getting various loans that are forgivable, and what is accounting for that? That really isn't covered under 606, because 606 is about exchange transactions. In this case, the government may be giving you a free loan, so that's a non-exchange transaction. For those, and I know we have a few governments on the phone as I look through the list, FASB has some non-exchange revenue recognition criteria, and so kind of facts and circumstances on how that might be applied. The not-for-profit also has some contribution guidance, but when it comes to general commercial entities, there's actually no guidance in FASB that covers basically governmental assistance. So there's no authoritative guidance on that. What most people do is they default to the international guidance. International does have a standard on governmental assistance. Where I normally see governmental assistance is, for example, in, say, an energy sector, where somebody's working on some alternative form of energy, call it solar, wind power, whatever, and the government says, hey, you bought this equipment and we're gonna subsidize your purchase of this equipment. So you bought a piece of equipment for $100,000, the government says we're going to give you a grant for $40,000. In the guidance for international standards, they'd say, well, there's two ways to record that. One is you could just net it against the asset. So you bought an asset for 100,000, government subsidized it for 40, so you booked the asset at 60,000, and you just net it against the asset. Or they cover certain expenses and you just netted it against the expenses. The other option is you could defer that and recognize it over time, meaning you bought the asset for 100,000, you deferred the 40,000, and then you amortize that 40,000 commensurate with the depreciation expense, so that the depreciation expense of the asset and the revenue being recognized would offset each other. Both situations, what they're trying to do is get an offset. In this situation, it's a little bit unique and some uncharted territory. So you could recognize that revenue and net it against your expenses. Again, that's non-authoritative, and we don't recommend that as a firm. We've been recommending that people recognize everything gross. The other thing is that it's a conditional. There's some conditions attached to these loans, and those conditions vary from did you hire everybody back, or did you hire enough of the people back, 75% of the people back? Did you qualify for the loan in the first place? Congress has been consistently modifying and tweaking. I mean, when they spent a couple trillion in a couple of weeks, there were obviously some loopholes in there where people got a hold of money that the government said, hey, it wasn't really intended for you, and so the forgiveness is really uncertain. So what we're recommending is, again, in lack of guidance, and right now the SEC is under evaluation on what they think the guidance should be, but there's no clear guidance yet. We think that people should recognize your expenses like you normally would, and then recognize the forgiveness once you've completed that forgiveness cycle. For most entities that are 12/30 engagement, it'll happen within the same year. If you're a 5/31 year end or a 6/30 year end and you received funding in March or April, and the forgiveness is going to happen after year end, then there's some uncertainty. But we believe an appropriate approach would be to recognize that forgiveness when it happens, because there's enough uncertainty around that forgiveness and the qualifications, particularly if you anticipate to meet the qualifications, but as time goes on, the statement orders are continue to extend, or the return of your customer base is extended out for whatever reason. You may have the intention of meeting the qualifications, but as it turns out, you may not meet those qualifications, because every day is kind of a new day in the current environment. So we recommend that you recognize expenses like you normally would, and that you recognize forgiveness at the end once you've achieved actual forgiveness. So anyway, that's, again, but no authoritative guidance on that, so that's what our recommendation is. And then Andrew, I'll hand it off to you, this last point talking about I.R.S slides, and you can kind of take it from here. I.R.S on the expenses being paid with those proceeds.
Yeah, thanks, Scott. The IRS and us thus far is taking basically the exact opposite approach that Scott just described. Under the language in the CARES Act statute, the forgiveness of income, or the forgiveness of debt generally creates taxable income for a taxpayer, but they put in an exception that said, to the extent that these loans are forgiven, you do not need to recognize that forgiveness as taxable income, which is great because we then don't have to pay tax on the money we got from the government. But then the IRS last week came out and said, because you are not paying tax on that income, you don't get to deduct the expenses that you're paying with those funds. So therefore, the wages that you're paying, the utilities, the rent over the course of this 8-week period that end up getting forgiven do not generate tax deductions. And several members of Congress very quickly jumped up and said, no, that's not what we want. We expected taxpayers were going to get effectively a double benefit in that they have non-taxable income coming in, and then they generate a tax benefit with that free income, so to speak, to reduce their otherwise taxable income. Unfortunately, from a procedural standpoint, where we are right now is the notice that the IRS issued stating that these expenses were not deductible is likely to be their final answer. I don't know that we're going to see them reconsidering their position. However, given the reaction of several members of Congress from both parties, I think we may be seeing this corrected in future legislation. So stay tuned. As of right now, we aren't anticipating any legislation being passed in the immediate term within the next 1 or 2 weeks, but this provision may very well find its way into the next round of disaster relief. And so I'm going to talk a little bit about the tax implications, both of what Scott was describing related to the ASC 606, but on the tax side, in addition to what he has, we have some new provisions as well that were enacted in the Tax Cuts and Jobs Act at the end of 2017 that are now effective for our clients starting in 2018, but we're seeing a little more movement on these now in 2019 as people are working through the ASC 606 implementation. And we unfortunately need to view these really as 3 separate projects. They do overlap to some degree and in some circumstances, but it's really 3 separate hoops, so to speak, that we need to jump through from a tax perspective to get to our correct revenue recognition answer. And for the ASC 606 rules, some of you may actually be thinking this question right now, which is, how does this align with my tax return? Do I recognize the same amount of revenue that Scott is recognizing on the financial statements? Does that go directly on my tax return? And if so, what sort of compliance requirements do I have? Do I have accounting method changes? Do I have new book tax differences? How does this hit my tax return? 451B is a new provision in the TCJA that is a one-way book tax conformity rule, basically saying that I cannot defer revenue for tax purposes later than Scott does on the book side. Because Scott and I tend to view revenue in an opposite way in that he prefers to report it earlier and I prefer not to. I prefer to push that revenue out as far as I can to avoid paying taxes on it. And so 451B was aimed at those people who are trying to have their cake and eat it too, getting an acceleration for Scott's purposes, but a deferral for my purposes. So what they're doing is forcing me to follow Scott, where I am coming to a better or a deferral, an answer that defers the revenue later than him. It forces me onto his analysis. And 451C, this is also an area of significant non-conformity between book and tax. The IRS's view is when I have cash, I have income. Even though I'm an accrual basis taxpayer, even though I haven't earned this yet, once I've got that cash in my hand, I have a potential tax liability. 451C is my opportunity to defer that, but I have a very limited deferral period compared to what typically happens on the financial reporting side. So first, ASC 606. As a baseline, ASC 606 did not change our tax revenue recognition rules. Nothing in the Internal Revenue Code was directly changed by ASC 606. So that means that if I am an accrual basis taxpayer for tax purposes, I'm still subject to the all events test. That is a 2-part test that states that I'm required to recognize income once all events have occurred that fix my right to receive it, and I can determine the amount of income with reasonable accuracy. Generally, historically, we have viewed that first prong, the fixed right prong, to be satisfied on the earliest of when the income is earned, due, or received. And again, we may have some consistency with Scott on the earned and due portion, or excuse me, the earned and received portion. But once we have a very limited ability to defer cash that is received beyond what Scott can do. And where we're seeing, as people are working through these standards, we did get some guidance from the IRS in what aspects of Scott's analysis can be applied for tax purposes. And what they basically said is that we can rely on the book determination of performance obligations. So if Scott tells me this contract has 3 performance obligations, I can rely on that. I don't need to go back and do my own analysis. Similarly, if Scott tells me how much of the transaction or the contract price is assigned to each of those obligations, again, I can follow him. I don't need to do a separate analysis, which is very helpful because his team, as you might have gathered from his descriptions, probably burned a lot of brain cells coming up with the answers to those 2 questions. So we can just leverage off of what they've already done, and also their analysis of when the performance obligations are satisfied, meaning that we can rely on Scott's determination that this revenue is earned over time versus at a point in time. Where we run into some inconsistencies, the identification of contracts. Do I have an obligation here? And I think part of the issue there is that the IRS doesn't like to give us blanket rules for issues that are highly factual. And every customer's contracts are different, and they would prefer that we do those analyses separately from the auditors to make sure we're getting to the correct answer. But the biggest area that we run into issues is in the transaction price and variable consideration issues, like Scott was talking about with estimated returns and rebates and things like that. They're taking into account how much they expect to collect, and our tax obligation is tied to what do we have a fixed right to receive, and those numbers may not be the same. So we may have a situation where the amount of revenue that Scott is picking up is different than what we are going to be picking up on the tax side. So we've determined that we have a change on the ASC 606 side for financial reporting purposes. What do we do? The next step in our analysis from a tax perspective is to decide, is that method that they're using for ASC 606 permissible for tax purposes? Some may be, some may not be, related to when they're recognized, how much is recognized. We may or may not be able to follow Scott. If we decide that it is permissible for tax purposes, the IRS requires us to file a form notifying them that we're changing how we're reporting this revenue, similar to the prior period adjustment or cumulative catch-up adjustment you might see on the GAAP side. We have to do that same thing with the IRS, and it generates a filing obligation for us. However, if the method is permissible for tax purposes but generates an unfavorable result for an unfavorable result for tax purposes, do we really want to do that? Do we have to do that? Do we have some flexibility to say, yeah, thanks guys, but we're just going to stay on the method we were before? Some cases we can do that, some cases we cannot, but it is something worth investigating if we're getting an unfavorable result. And then if we determine that the ASC 606 method is not permissible for tax purposes, we have to do a new book tax or Schedule M adjustment to revise the book number to get to our proper tax number. And that may unfortunately require us to gather some additional detail from Scott's team or have him track certain components of that adjustment to make sure that we get those properly reversed. The Section 451B rules, this is tax only. And as I said, this was enacted as part of the Tax Cuts and Jobs Act at the end of 2017 as a revenue raiser. And as generally the rule in tax speak, revenue raisers are typically unfavorable for our clients, and this is no exception. This is an unfavorable provision that we want to do our best to avoid being subject to this. This will never get us a good answer, so we want to avoid this to the extent that we can. And the reason, as I alluded to earlier, is that they added a third prong to the all events test that state, in addition to meeting the fixed right and determinable with reasonable accuracy standards, I need to make sure I am not recognizing this revenue later than they are in financial statements. The good news is there is a somewhat narrow definition of financial statements that allows some of our clients to avoid this, but for those who do end up subject to this, this is a one-way street. I can only accelerate at revenue to meet what Scott is doing. If Scott decides he's deferring the revenue longer than I was, I don't get to go the other direction. I'm still stuck with my earlier recognition date. And a lot of people refer to this as a result as the AFS inclusion rule or the applicable financial statement inclusion rule. And the two key limitations in determining whether I'm subject to these rules is, first of all, determining that I'm one of the taxpayers that has an applicable financial statement. I only need to follow these rules if I have an applicable financial statement, which is defined as an audited financial statement. So it has to be audited. It cannot be reviewed or compiled or anything less than a GAAP basis audit. The other category of people subject to these rules are those who have an obligation to file financial statements with government or regulatory bodies. So unfortunately, this ensnared quite a few of our banking clients who may not have an audit, that may only do a review. So we thought they had clear sailing, but because of their obligation to file their financial statements with their regulatory agencies, they get caught up in this too and are subject to 451B. 451B also only applies to income that is subject to Section 451. So the 451 all events test we talked about earlier is the basic general overall rule for tax purposes, but as those of you who've ever seen the tax code is filled with exceptions and special rules and modifications, and there are a lot of different income recognition methods that are not governed by 451. So for example, long-term contracts for construction or manufacturing activities, those are not subject to 451. Installment sales are not subject to 451. Certain rental agreements are not subject to 451. And if we can determine that the particular income stream we're looking at is subject to a code section other than 451, we can avoid applying 451B, which is, again, somewhat helpful to our clients. And so far, this has maybe been a little bit understandable, maybe, and I say a little bit because tax rules are very rarely actually understandable. But so we've got the concept is I can't defer later than Scott. But now I'm faced with this long series of exceptions that, again, I'm motivated to try to fit under these exceptions if I can for tax purposes. So one of the rules is these provisions do not change the treatment of a transaction for tax purposes. An example here might be a lease. Scott may identify something as a capital lease for book purposes, but it is an operating or true lease for tax purposes, meaning he has an asset and liability on his balance sheet, he's taking depreciation expense, and we are not. We do not need to, change our treatment of those transactions to reclassify them as capital leases just because of 451B. If we go through our analysis and decide that we can treat this as an operating lease for tax purposes, we can avoid 451B and completely ignore what Scott is doing on the financial reporting side. Additionally, it doesn't accelerate realization events. So it does not force us to recognize a gain on a transaction that is not a closed and completed transaction. For example, the mark-to-market rules. Many assets and investments are mark-to-market for book purposes, but for tax purposes, unless we've made certain elections, we're generally not required to mark those to market, and we wait until we actually sell them. That rule still stands. We are not required to mark those assets to market for tax purposes just because we are for book purposes, so we can still have a book tax difference on that. And it also doesn't change the classification of transactions that are eligible for tax exemption. So your 1031 exchanges, where it may be a sale and a repurchase with a gain or loss on the book side, we can continue to treat that as a non-recognition transactions and follow the rules of 1031 or 1033. Similarly, the business reorganization or structuring transactions that are exempt from tax, those are also not subject to this rule. I think perhaps the most confusing and perhaps contentious aspect of these rules is how this applies to what are defined as contingent items. So some of the items Scott talked about, rebates, returns, things like that, those are amounts that are contingent on the occurrence or non-occurrence of a future event. That client or that customer needs to bring their merchandise back in order to have an actual return. They need to take some action in order to be entitled to a rebate. So those obligations are not fixed under the tax rules until that event occurs, which may be after the period in which the transaction occurs. So that's why first we can ignore some of the contingent purchase price adjustments that Scott is making. If he's increasing the purchase price by amounts that he expects will be collectible in the future but aren't fixed as of the end of the year, we can ignore that. However, the definition of contingent doesn't apply where we have an enforceable right to payment for performance completed to date. So historically, as Scott alluded to earlier, some construction contracts may have had a clause in them that said, that we don't have a right to bill you for this work and you have no obligation to pay us until we've delivered the finished product and you have reviewed it, inspected it, and accepted it. And for tax purposes, historically, what we had been doing is saying that is a fact that is necessary to fix our right to receive this income. So we're going to defer recognizing the income until that occurs at the end of the period. Now, that is not always the case. As Scott alluded to, for contracts where we have a right to bill for what has been done to date, even though we can't bill for the whole thing, that makes that component of the transaction non-contingent. So there might be a piece of the purchase price that is contingent to the extent that we don't have a right to bill it, but to the extent that we do, we have a satisfied obligation. And if Scott is accelerating the revenue, we need to do the same. So that is an unfortunate impact for a number of our clients, given what Scott said earlier, where there are more contracts recognized over time now. So that is forcing an acceleration both on the book and tax side, which is not ideal from our perspective. And then there are, as you might imagine, a number of unique scenarios that can arise in trying to apply these rules. So for example, I have a US entity that might be included in a consolidated financial statement of a foreign entity. Am I subject to 451B? What happens where I have a different tax reporting year than financial reporting year, which again can happen for some entities and can happen where you have commonly controlled entities. What happens if the deferred revenue liability is adjusted in the financial statements following a transaction? Does that force recognition on my side? What happens if Scott restates the financial statements? What does that do to my tax rules? And there are also specific rules for debt instruments that we aren't going to talk about in the hopes of all staying awake this morning. But if you have these sort of scenarios, then there's an additional level of complexity that we're going to need to work through to figure out how much revenue you need to recognize under 451B. This is an example of a client situation we've worked through this year where we had both a change on the ASC 606 side and then a change on the 451B side. So this client provided data hosting services, and they would sign multi-period, either multi-year, multi-month contracts with customers and provide a free introductory period, either a month, several months, where they did not send or invoice the customer for services during that period, and then they begin billing them on a monthly basis going forward. Historically, what they had been doing was recognizing revenue only when billed. So they did not recognize any revenue during that introductory period because they did not bill for that period. ASC 606, the auditors came in and said, really what you have here is a single performance obligation that covers from the date the contract begins in the free intro period through the end of the period, and you are satisfying that ratably over the term. As a result, your revenue for that contract needs to be spread over the term, including the free intro period. So now instead of having a few months with no income at the beginning, we have a flat line, consistent, slightly lower number that we're picking up for each period over the terms of the contract. So on the tax side, we have to consider both the application of ASC 606 and 451B. So as I said earlier, if Scott tells me they have one performance obligation and that performance obligation is satisfied over time, I can adopt that. I can follow Scott's methodology, identify that performance obligation, and treat it as satisfied over time. Under our current, so that's my ASC 606 side of this analysis. My 451B side requires me to sit down and say, okay, what am I getting to right now under my current tax method? So my current tax method was the same as my book method before ASC 606, which was I didn't recognize any revenue during that intro period. The new book method is forcing Scott to pick up some revenue during that intro period. 451B then kicks in to say I have to do the same. So I have to move to the method that Scott is using to recognize that income ratably over the contract period. We're moving on. So as I said, 451B is probably it is more complex than 451C and is one of the more cumbersome aspects of the tax reform rules. 451C is more straightforward and is more consistent with how we viewed things prior to tax reform. So the 451C applies to what we call in the tax world advance payments. Advance payments are defined as amounts that we receive for goods or services to be provided in the future. So it could be you prepaying for you are a landscape contractor and you take prepayment for all of the work you're going to do over the course of the summer to maintain the yards. Maybe you're selling multiple pieces of equipment or multiple physical assets, and you collect an upfront down payment before you've delivered any of those, or you're providing software licenses. Gift cards is another area. When a customer comes into your store and buys a gift card, they've given you $50 that someday they're going to come back and take away $50 of goods without giving you any cash, but you have the cash in hand right now, which again, under the IRS rules says I have income unless I can find a way to defer it. These are typically reflected on the balance sheet as a deferred revenue, unearned revenue, customer deposit liability, and they can be significant for some industries. And this is also, as I alluded to, a significant source of book tax nonconformity. Typically, for an accrual basis book analysis, we're going to be focused on when it's earned and not when it's collected, but I need to focus on when it's collected. 451C tells me that I can adopt a 1-year deferral period after the year of receipt. So that means that in the year I collect the income, I recognize the same amount of income as Scott does. And then the following year, I have to take it all into account. Even if this is a 3 or 4 or more year performance obligation and Scott is spreading it over that longer term, I have no choice. Everything needs to hit my tax return by the end of the second year. And those of you who have worked in this space before may be familiar with Revenue Procedure 2004-34, and this rule is effectively consistent with that. This basically embodies that rule into the Internal Revenue Code. What it also did was it eliminated a 2-year deferral method that was previously available under 451-5, but only for the sale of goods. So some of you may have been using that method in the past. You will need to file a 3115 to give up your 2-year deferral and move to a 1-year deferral method. And a quick example here, this is similar to the franchise example that Scott was just talking about. When a taxpayer transfers a franchise, it included the transfer of a number of things, supplies, training, but also a right to use that franchise over an extended period of time. And in addition, in connection with generating those franchises, the taxpayer would pay commissions to employees or third parties who were engaged to go out and get new franchisees to sign up. Historically, what had been happening was we were recognizing that revenue, all that revenue and all that expense up front, I believe. And then after ASC 606, they identified multiple performance obligations and said that the training and supplies obligations are satisfied at the beginning of the term. So the revenue related to that continues to be recognized on day 1. But the franchise fee covers the full 5, 10, whatever year period that the franchise right is granted. And so therefore we should be deferring and recognizing that ratably over the franchise agreement. Similarly, the prepaid commission expenses are required to be capitalized and amortized over the term of the franchise. Those were costs that were incurred in obtaining or creating those franchises and need to be matched with the term of the franchise. For tax purposes now, we actually have 3 issues we need to consider. ASC 606, 451C, because we have an advance payment, and then the commission expense, which is a separate issue for us on the tax side. So ASC 606, again, I'm going to follow Scott and identify the same performance obligations as he is, and I'm going to allocate the consideration the same, and I'm going to recognize it using the same pattern that they're doing for book purposes. 451C tells me, again, this is a payment I've received for the right to use a franchise that will occur over a number of years in the future. So it is by definition an advance payment. I can follow Scott in year 1, but I have to recognize the rest of that revenue in year 2. So this is actually a minorly favorable change for our clients, because instead of recognizing all of that franchise revenue in year 1, we recognize a portion in year 1 and then the remainder in year 2. So we are generating a small deferral benefit. Something to keep in mind if you're trying to decide whether or not to apply these rules: is the tax savings worthwhile to you to bite the bullet and to adopt those rules in 2019? The prepaid commissions, again, from a tax perspective, a payment that generates a rider benefit that extends beyond the year of the payment has to be capitalized and amortized. So similar to what Scott is doing, we need to capitalize the cost of that expense and amortize it over the term. And again, there's no 2-year rule here, so I'm going to be capitalizing and amortizing that expense over 10 years, the full term of the franchise. But because this is considered an expense item rather than a revenue item, I actually have a new accounting method change that I need to do in order to implement this. Well, I mean, it's the takeaway on the tax side is for each of these three provisions, you need to decide how many of them apply to your specific situation. If you have a GAAP audited financial statement, you're subject to ASC 606, and you need to go through that analysis for tax purposes. 451B is only going to apply if you have an audited financial statement or a financial statement you're filing with the government. If you don't fall into those categories, you can ignore everything I said about 451B. 451C, you need to determine if you have deferred revenue. Scanning your balance sheet to see, do you have anything on your balance sheet that might indicate you've collected cash but not performed an obligation to date? Then you need to work through the 451C analysis. So taxpayers can be subject to any combination, 1, 2, 3, really any combination of these three provisions depending on their specific circumstances. And Amy, did we have a question?
No, no
Okay.
questions.
Scott, anything to wrap up here?
No, I think you've got it covered. So if you have any questions, feel free to reach out to, your Eide professional, and we can certainly help you through any specific facts and circumstances that you might have.
Awesome. Well, thank you all so much for attending, and thank you to Andrea and Scott for presenting this. And we hope everyone has a great day.